many screws it took to build that house. No. To me is indirect materials. They would just say, yeah, we bought this many screws and we're going to take that cost and we're going to spread it out amongst the jobs in some way, but we're not going to be like, how many screws did you take to build that A-frame that you built off in the woods somewhere? That'd be impossible. And the same thing is true for indirect labor. Indirect labor is the cost of the salaries of people who work at the manufacturing place, or they do, the manufacturing job, but they're not directly doing it themselves. So say you have a company that makes customized furniture. People, the carpenters running the saws, they're direct labor. You know exactly what thing they're building when they're working. But they need support staff. What do they need? Well, there's going to be some kind of production manager that oversees all of the different things those people are constructing. You need someone to clean up afterwards, so that's going to be the custodial staff. Again, they support all the direct laborers, but they don't actually directly make the product. And then security. They have to feel safe and sound when they're at work. Security is going to be a necessary thing to have at your manufacturing firm, but they don't directly work on the jobs. So their costs are necessary costs of production, but since they aren't punching the clock in and saying, I'm working on the production of job A21 today, they just do their job in support, you can't directly assign their costs. So indirect labor goes into manufacturing overhead, as does, and when we think of the word overhead, this is usually what comes to people's mind, all of the costs related to the actual facility that they work in. So your rent, your utilities, your insurance, your property taxes, etc. You can't figure out, how much utilities a saw used up, how much electricity a saw used up to make one particular product versus another. There's not a way that no one's going out and reading the meter after every job gets done. That would be crazy. So they pull those costs up, and that is the other part of manufacturing overhead. So over here we have a microprocessor that's going to be used in making a tablet. What would be a direct material for that particular product? Well, that microprocessor is. You know what particular type of tablet that microprocessor is being used for when you sign it out. So that would be a direct material. Again, the people that construct these things would punch in and they would say, I am making, the Fire Pro tablet or whatever name that you want. And because they punched on the clock saying what job they were working on, it's very easy to spread their costs to that job because it's directly linked. But some things aren't so easy, and my thing here is glue. Imagine if you had to glue each one of these microprocessors to some kind of circuit board, and your boss came and said, I need to know to the 10th of an ounce how much glue you use to produce that. No one is weighing the glue. That would be crazy. So that is an indirect cost. Yes, it's necessary for this because there's no way to easily trace it to each job. You're just going to throw all those costs into your pool and then spread that pooled cost out amongst all of your different products. Another bit of verbiage you're going to hear is prime costs and conversion costs. So prime means of the most importance. Like prime rib is supposed to be the best cut of steak that you can get. Those are the things that you have to have before you can even think about being a manufacturing firm. But what things would you have to have? The materials to make those goods and the skilled laborers there that know how to turn those raw materials into a product which they can sell later. So direct materials and direct labor are examples of prime costs. Conversion costs are the things that take those raw materials that are sitting around and are paid for the process of converting them to a finished good. So direct labor is also a conversion cost because you need those people to convert those raw materials to a finished product. You also need to pay your rent to have a facility to do it. You need to pay your utilities to have heat and electricity in place. You need to have those indirect materials and those indirect laborers working at the place to oversee things and to support your actual direct manufacturers. So manufacturing overhead is a conversion cost. So direct labor here is the overlap. Prime costs, direct materials, direct labor. Conversion costs, direct labor, and manufacturing overhead. All of these things that I've been talking about so far, the raw materials, the laborers that work directly on the products, the laborers that support those, all of the utilities, rent, taxes, etc. you have to pay on a manufacturing plant, those are all costs directly traced to production. And they call those product costs. They are the costs that you pay to convert those raw or direct materials into a finished sellable good. Those costs I refer to personally as inventoriable costs. And the reason being is when you pay those costs, instead of recording an expense on your income statement, etc., at the time that it happens, what you're actually doing is you're building up an asset. You're producing those goods which you're going to sell later. So any cost directly related to production is a product cost. And when you incur that cost, instead of declaring some kind of expense and writing it off on your books, you actually add those costs to your inventory asset account. The opposite of that is period costs, or as I call them, non-inventoriable costs. Those are the costs that are necessary for the business to operate efficiently, but have nothing to do with production. So things like selling expenses, paying for advertising, paying your marketers, administrative expenses, paying your CEO, COO, CFO, all of those people, and anything on a facility you have where production doesn't happen, like a corporate headquarters. All of those costs can't be inventory because they're not directly related to production. So those are defined as period costs, and in those type of costs you can expense as soon as you receive them. So for Smart Touch Learning over here, making the tablets, once again, what is a non-manufacturing cost? Well, there's that marketer right there, but she doesn't directly work in production, which means that's a non-inventoriable, non-manufacturing cost. You could expense it when it happens. Administration and all of the costs that you pay for the building where administration works, again, not directly related to manufacturing. Can't be inventoried, so you expense it when it's incurred. But for product costs, those three things that we saw on the slide earlier, the microprocessor, the laborer who puts it in, and that glue that counts as an indirect material but is still necessary for production, they are all manufacturing costs. They're all inventoriable. So as you are working on a product, all those costs that you incur, they go into your inventory account, recorded as an asset first, and then when you actually sell it, that's when you get to expense it. So for a manufacturing firm, you're actually building up the value of an asset until the time it's actually sold, and that is when you finally get to expense it as a cost of goods sold. So here's a list of things. Let's run through each one and see where it falls. We have depreciation on manufacturing equipment. That is directly related to manufacturing. These are the tools that they use to actually make the goods. It's the loss in value of all the equipment that you do so to produce that product. The problem is it's very hard to trace exactly how much time or how much value is lost on the equipment for making each particular product or job. That's too hard, so you throw it into manufacturing overhead, but it is still an inventoriable cost. What if that equipment wasn't used in manufacturing and it was used in actual in your office for administration? That's not related to manufacturing. Therefore, that is not an inventoriable product cost, and you get to expense it as a period cost. Advertising, same thing, necessary component of the business, one of the biggest expenses any business will have, but since it's not directly tied to production, that counts as a period cost. Property taxes, we have two lines right here, and insurance. There's one on our administrative office, and the fifth line down, it's on our production facility. Well, the one on our administrative office, nothing gets manufactured there, which means those taxes and insurance for that place aren't inventoriable. They're a period cost. But if it's property taxes and insurance on our production facility, on our factory, well, that is related to production, so that gets to go into manufacturing overhead. A production supervisor, again, is an example of an indirect laborer necessary for production but doesn't actually work on building the inventory himself or herself, so that goes into manufacturing overhead, but it's still an inventoriable product cost. The CEO, no, because they won't be sitting at your production facility. They don't oversee the people as they're actually working. They have higher level things to do within the company. Period cost. Assembly line workers, that's a direct cost. You know what job your assembly line workers are working on. That's direct labor. It's still an inventoriable product cost. Batteries, processors, and other materials that Smart Touch would use to make these tablets, those are direct materials. You can trace how much of that went into a particular job, therefore that is going to fall under product costs and be inventoriable. But again, you might have some supplies in there, like the glue, for example, which you can't trace. There's no easy way to do it. If you have a good that is directly needed for production, but there's no efficient way to trace the cost to particular jobs or products, you throw it into your manufacturing overhead pool, still an inventoriable cost, so on and so forth. That's the gist of how it works. You got to ask yourself the first question whenever you incur a cost: is this directly related to production? If the answer is yes, you know it's got to be a product cost. The second level is to ask yourself, is the cost of this traceable to a particular line or product? And if the answer to that is yes, it's a direct cost, either materials or labor. If the answer is no, it goes into your manufacturing overhead pool. And if the cost that you had is not related to manufacturing at all, you can just expense it at the time that you get it, and it becomes a period cost. So the financial statements for a manufacturing firm deal with the changes in the value of your inventory. Like I said, when you are a manufacturing firm, you can't write off every expense that you have at the time that you paid for it. If it's to build inventory, you need to put it into the value of that inventory, and you can only expense it when it's actually sold. So this makes their income statements very much different from a service company. On a service company, you don't have to worry about inventory. You don't sell stuff. For a merchandiser, every inventory you have is in a sellable condition because you bought it from somebody else who made it, and it's complete, and you're just marking it up. So you only have one balance of inventory. But for a manufacturing company, we got to track all of the changes to the amount of raw materials that we had, the costs that were in jobs that are in process, or maybe the cost of jobs that were in process that we finished. Eventually, we're going to get to the cost that we have in all of our finished sellable goods sitting around at the end of the period. So for a manufacturing company, as you can see in the third balance sheet over, you have to report your inventory not just as a line of inventory, but as 3 separate lines that lets the people inside your company who want to know, what state are we in as far as being able to turn this asset into cash, how close we are to doing so. So you're going to report your raw materials inventory, your WIP, and your finished goods. And on the income statement, again, service companies don't have to worry about any of this stuff. They don't have inventory to deal with. So whenever something happens to them, they're not product costs because they don't have products. So they get to expense everything at the time that it happens. For a merchandiser, you would buy those goods, you would have them on your books as inventory until you actually sold them, then you can record the cost of goods sold. Because a manufacturer makes their own products, well, the calculation of cost of goods sold is a step-by-step process. It's determining how the costs change between your raw materials, your WIP, and your finished goods. And over here on our income statement, as you can see on the left side, service company, no inventory to worry about. You don't have to worry about anything. In the middle, we have a merchandising company. They only have one type of inventory, and that is their merchandise inventory. And they track how they got, to their particular cost of goods sold by using the following formula, which is the beginning inventory that you have plus any additions. So that would be the purchases and all the associated costs like shipping that come with purchases. That's your addition. So whatever you had to start with plus whatever you added during the period is the amount that you could have sold, the cost of goods available for sale. Well, you probably didn't sell everything during the period. And you're going to have ending inventory on your books, in this case for a retailer, ending merchandise inventory. Well, if you take what you could have sold, your cost of goods available for sale, and subtract out what you didn't sell, that tells you what you actually sold, and that's how you get to your cost of goods sold. A manufacturing company follows these same steps. Beginning plus addition gives you the amount that's available for sale. And if you take the amount that was available for sale and subtract out what you have left over as ending inventory, that gives you what you actually sold. They do the same process, but now, because they have different classifications of inventory, they don't just call it merchandise inventory, they call it finished goods inventory. And with that, that is the cost flow of inventory costs for a manufacturing firm. As you are working on production, the costs that go into making a good are going to keep changing accounts until they eventually get sold. So you bought all of these materials that you have sitting around, all of your raw materials waiting to be